I don't have my recording information all set up, so we're gonna do this in the dark with the old school camera, but we gotta get this done, so let's go. Also, say hi to Booby. Say hi. Anyways, the Fed cut rates today. That means mortgage rates are coming down, right? Not so fast. So what really happened? The Fed cut the overnight lending rate by about a quarter. This was expected and hoped for by the market. What wasn't expected or hoped for by the market was Powell mentioned another cut this year is not guaranteed. Long story short, he said the economy is cooling, unemployment is going up, but for now both are still doing okay. He also mentioned that inflation is slightly increasing again. It's still not extremely high, but at 3% for the first time in a year, and is moving away from the 2% target, mostly due to tariffs. Usually when unemployment goes up, rates come down. But when inflation goes up, so do rates. They rarely both happen at the same time. And with both things happening, the Fed is kind of stuck, at least as far as what to do next, when they're going to lower rates again, and how much rates are going to come down. Now, Powell did mention that the committee was not 100% in agreement on what to do next, or even this time. He did mention at least one member of the FOMC didn't want to cut rates at all, and at least one or two wanted to cut even deeper than we did today. One interesting note is that they said they're going to stop selling their bonds. They're going to quit reducing what's on their balance sheet. In 2020, they decided to increase their balance sheet by buying all kinds of bonds, including mortgage-backed securities, to keep the economy afloat and to help support the housing market from completely collapsing if there was no easing. Since then, I think late in 2021 or at some point in 2022, they started to sell these bonds into the market. Simple supply and demand says, as the Fed, one of the largest bond holders in the history of the world, decides to sell these bonds into the open market, it makes bonds less attractive. Higher supply, unchanged demand, or actually worse demand because the Fed is no longer buying them. And that's actually one of the reasons that rates have stayed elevated. Now they said they're going to stop doing that. The balance sheet is back to normal levels. There's no more quantitative easing, and there's no more selling these bonds back to the market, which will create a more normal circumstance going forward. That's a very small but a good thing for mortgage rates. So what happened to mortgage rates today? That's the question, right? Well, as I've told my viewers so many times over the past however many years I've been doing this, and when I was doing it in text only and even blogs, when the Fed lowers the overnight lending rate, that doesn't mean anything for mortgage rates necessarily. In fact, like today, they often go up that day. Now, when I say rates went up, it's not that big of a deal, but they did go up today, back to where they were Monday. Anyways, if you'd like to know how this works, just let me know. You can probably find some old videos, but I don't mind making a new one.